We're talking about what should you do with your portfolio ahead of Budget 2024. Now, the budget will be passed and will actually be presented by Finance Minister Nirmala Sitharaman on the 23rd of July. So we have less than a week or a little more than a week remaining for the budget to come through. Why this is also an important budget this time round is because it's the first budget of the third term of the Modi government, and we will get an insight into what is the policy landscape or the roadmap that the government is setting up. Now, why does this matter to your mutual fund investments? Well, let me give an example. Some of the best performing funds in the last few months, or even if I start from the last budget, the last full budget to now, have been thematic funds, PSU funds. There you have that list. We've taken the starting point as February 2023 when the last full budget was presented, and look at those funds. You have a PSU fund, you have an infra fund, and these are pretty much the ones which have really kicked off with their inputs. The reason for this is it's reflecting the government's focus on these sectors. Now, our question today and what we're going to be talking about with our guests is whether that is the kind of investment that you should make, and how do you see this as an opportunity to shore up your mutual fund investments. To talk more on this, I'm going to be speaking today with Trideep Mahajan, Managing Partner and CEO at Complete Circle Wealth Solutions, and Trideep Bhattacharya, President and CIO of Equities at Edelweiss Mutual Fund. Let me first begin with Trideep and his view. Trideep, great to have you on the show and speak with us here on the Mutual Fund Show. Let's begin with your overview on what you're expecting from the budget. I know the industry also has its own set of wish lists when it comes to taxation, parity of taxation between debt and equity. Do you think these are some of the key themes that will dominate?
Yes, I think that is something which Honorable Prime Minister could address, Finance Minister could address. But I think the main focus is likely to be, which the market is waiting to hear really, from a broader direction standpoint, is this will be the first budget after the new government has sort of taken over with a slightly weaker mandate than what people thought of initially. So how much is the dilution to the focus that, or the promises that they had made earlier versus the continuity of the same going forward? How much do they have to relent in the form of populist measures are some of the key areas that at market participants we would be watching carefully to take a gauge on the future stance of the market overall. But if you were to ask me in terms of the focus areas for the budget, I would say that broadly speaking, the path to Viksit Bharat 2047 would actually be seen in the which actually continue in the form of incentives to sectors like capex, railways, autos, renewable energy, and manufacturing, and along with maybe a few measures to stimulate rural demand, because that's one area which has been sagging for a while and might be kind of taken into consideration by Honorable Finance Minister. So those would be the two specs that I would expect to get addressed, along with maybe taxation and stuff like that, would be my starting comments.
Okay, so taxation to boost consumption, your capital expenditure push continues, focus on rural demand. So, Trideep, if I were to ask you to translate that into an investment strategy, especially for our viewers of the Mutual Fund Show, what would be your response?
I think overall, budget is just a small part of the investment horizon of investors, which should anyway be between 3 to 5 years. And if I were to look at the next 3 to 5 years, then I would say that 2 or 3 things will likely dominate investment returns. One is the overwhelming focus on manufacturing over consumption. I think with regards to capital creation, with regards to the government focus, and also private sector capex, given where the capacity utilization of India Inc. is, I think over the next 3 to 5 years, manufacturing over consumption would be one dominant theme that I would expect to play out from an investor standpoint. Second, I think given where valuations are within consumption, I think within consumption, rural consumption would actually have a few better days ahead, given the likelihood of better monsoon, and also that government would likely boost some measures which could kickstart demand in this area. So those would be overall from a sector overweight, underweight standpoint, manufacturing over consumption, and within consumption, rural demand over urban demand over the next 1 to 2 years would be the areas to focus.
Okay, so focus on rural demand, focus on manufacturing over consumption. Kshitij Mahajan also joins us today. Kshitij, hi, great to have you on the show. As always, let's talk a bit about thematic funds, and let's now bring the conversation to the bread and butter, what people can do. All of these ideas sound great. We're looking forward to a constructive budget. The question is, how does it translate into some of your investment decisions? And we just pulled out that data. We'll pull it up again for our viewers on what are the top performing funds from the last full budget. We've not taken the interim budget pre-election into question over here. We've started from February 2023 till now. Now 141%, for example, returns on the Invesco India PSU fund. So PSUs, defense, these are been some of the themes that have worked. Little surprised then there's so many NFOs coming out also around these themes. Are these a good idea, Kshitij, right now, or better to stay away? I think you're on mute, Kshitij.
Hi, Tamanna. Hi, Trideep. I think Trideep have set the context right in terms of expectation. So my worry here is, Tamanna, that wherever there is a valuation mismatch, irrespective of how focused government is, how focused our industry is, you will bound to see some correction, and that's what is happening right now. So these numbers are looking good. I can understand with the PSUs, defense, railways, but how many years you're discounting, one has to take into account. And when you're talking about the funds which are sectoral specific or thematic funds, which we spoke earlier also, I think one has to focus on clear-cut what with this little bit of fracture mandate, I will say the government has come, not with a clean mandate, I must say, what type of focus they will have. One, ruler for sure. So I think the way, we all have that 15-20 years of work in this industry, and we have seen the sectoral rotation is becoming very fast. So one has to understand the theme, the focus of government will for sure will be ruler for sure, and you have the ruler demand consumption piece will do well. At the same time, manufacturing will remain the flavor because they are very clear they want to have 25% contribution of GDP coming from manufacturing by 2030. That will create jobs as well as you become self-reliant, less dependency on imports. So that will keep on growing. But yes, wherever, in that piece also, the valuation mismatch is there. One has to be a little careful. And I don't mind, booking some profit or maybe taking some chips off from all these high-valued sectors or themes or stocks where earnings are not that supportive. But yes, I see that in current scenario, wherever you are seeing some new funds coming, so just be watchful with the valuation. The type of holdings which, because they propagate about what type of sector, what type of industry they are investing into, just be a little watchful about the valuations also, because end of the day, at any given point in time, if it's not catching up now, earning has to catch up or price has to go down. So it has to marry both sides. So I think this is something which is worrying me. But consumption is one sector where I see one can actually look at participating. This is something which is very this is a personal view. There's no recommendation. Second thing which I see that BFSI as a sector or maybe as a team which has not played well in last 4 years is dragging, or maybe it's underplaying Nifty as number also, that too sector. Manufacturing as a broader theme, yes, it will and it should do well, but then you have to pick your pockets. So I think at present scenario, just look at those sectors where the valuation mismatch is not much. And otherwise, you can play these themes through flexi-cap or multi-cap funds. That's a better way of doing it, rather than just looking at playing it through a pure sectoral or thematic funds. Because to my extent, whatever I understand from market scenario right now, there is some sort of fraud building up in some space, whether it's PSU banks, PSU companies, defense, some few of the stocks, and then you have railway stocks. So one has to be a little watchful and careful while investing into these type of themes.
Okay, so now I'll tell you the one line from your commentary or opening comments that really struck me, and I want to come back to Kshitij, is where you said, I don't mind booking some profits at this point in some of these funds which have run up. Let's get into that more specifically. I mean, a lot of people right now are wondering whether there is one bout of profit booking coming. A lot of investors have seen handsome returns, to say the least. Would you say it makes sense to go back, look at your portfolio and maybe unwind some of those positions or book some of those profits?
Yes, Tamanna, very well. You said it rightly. Asset allocation is one thing which we always come out with. And with the current equity run-up, you see that you must have, whether you have not gone back and seen, but if you see that your asset allocation is way towards in excess of what you have thought of participation in equities. So if you want to rebalance it, and right now you have a very lucrative window in fixed income also. So I'm just taking a deviation from what we are discussing. You have fixed income part also where you have gilt funds where we are expecting a rate cut which are very much capable of delivering 10-11% in next 1 year or next 1 year's time. So I think it's a good time where you can actually look at booking some profit from those funds which have rallied up really fast and not with the proper earning guidance for next 5, 6, 7 years, or maybe not supportive earning guidance. So wherever there is a mismatch, I again use the term, and the mismatch is really big. I don't mind, booking some or taking some chips off and booking some profit and parking the same back to fixed income as and when you have some opportunity coming your way, keep some powder dry, and you can participate again into those sectors or maybe a multi-cap fund. Or if you don't want to do it at your service rebalancing, maybe you can move to a balanced advantage fund. In fact, even Edelweiss has a very beautiful balanced advantage fund. So you can look at participating into any of the BAFs. So I think that's the right way to do rather than just fixated with that, okay, I have this is the run up and this will keep on going. I don't think so that wherever there is a mismatch, it will keep on going like this.
Okay. All right. So look at that. You're seeing on an average, large cap funds have given you between 59 to 60% returns since the last budget. Some of your thematic funds are 130, 140% returns. I mean, it's been a dream run. Trideep, I know it's a tricky question for you, but nevertheless, without talking about any specific fund, I am going to ask you that question. Is this a time, if you're looking at your portfolio at an individual level as an asset manager, to review and take some profits off the table?
I think profit booking and as long as you can put it to work and reinvest it at a level where returns are better should always be looked at. And I would say if you look at over the last 1 year or so, particularly the data that you are showing us shows a meaningful amount of returns have been made in some of the areas like PSUs and also some of the other areas like infrastructure and stuff like that. So two aspects to this. One is that, I think at the moment, one statement I would clearly make without making life tough, which is that I think generally diversified funds make a lot of sense at this point in time than sectoral funds. That's the first statement that I would make, because in diversified funds, the fund manager has the flexibility to move between themes, basis, the changing direction, and also the changing valuations, which are moving quite significantly. Now, in this context, for instance, in the last month or so, there was a large defense index fund which has been launched overall. So clearly, some of those stocks have had very strong days overall from that perspective. Now, that's not to say that the government's focus from defense is likely going to go away. No, in fact, it's going to probably strengthen. But versus that of valuations, given that we have seen already stocks run up quite meaningfully, maybe things may even out over a period of time. Hence, I was suggesting that two of the funds, two of the categories of funds which are my favorites in this current circumstances would be a flexi-cap fund or a multi-cap fund, because it kind of gives the investors and the fund manager leeway to move around wherever valuations are still sanguine, earnings growth still robust, and valuations don't fully capture what earnings growth is likely to reflect. So maybe from some of these thematic funds, profit booking could be looked at and moved on to more diversified funds like flexi-cap and multi-cap funds. That certainly I would probably wouldn't mind shying away from talking straight on your show.
Yeah, I'm glad for that, Trideep, and I really appreciate it because, that's what at the end of the day we're talking about investors and viewers. All right, more on investors and viewers. We're taking a very short break. On the other side, we come back with your queries. Kshitij Mahajan takes them. Trideep, I thank you so much for joining us today, but we come back on the other side with Kshitij Mahajan and some of your queries. Stay tuned.